So last night, the biggest data point release was the US GDP number, which we think was far more meaningful than the FOMC last night. So the GDP number for Q2 came in at 4% quarter-on-quarter seasonally adjusted annualized rate, which was far higher than what was expected by consensus. This just keeps us on track for accelerating growth in the US, which we think as accelerating further into the remaining quarters of this year and into next year. In terms of the FOMC, there was really no change in policy. They kept tapering on track. They reduced their pace of purchases by another $10 billion, and we think this will continue over the next meeting when they will basically conclude the asset purchases at the October FOMC. Not really. Argentina, we think, is a fairly contained situation. This default, so to say, was largely as anticipated, so that's not going to impact global markets on a very large scale. We think how the Q2 earnings results pan out, as well as how growth data pans out in the US and Europe, will be far more impactful. We think there'll be a couple of important challenges coming up for emerging markets globally in the second half, well, over the next couple of months. Firstly, we see the Fed changing its forward guidance, where it will start guiding on how and when it will start raising interest rates. The other thing, of course, is that growth and inflation is picking up in the US, which means that the Fed will have to start acknowledging that inflation picture in the US is getting better. So those are going to lead to an increase in US interest rates, which we think basically is a pricing benchmark for a lot of the carry trades that are bringing inflows into emerging markets in the first half of the year. So a part of that will have to be unwound. The other problem for emerging markets, of course, will be that similarly, the US dollar will probably also strengthen in the second half of this year, and that will again mean that currencies in emerging markets will weaken, and therefore investing in emerging markets will become relatively less attractive. The another part of the flow picture, of course, is how things develop in Europe, and the improvement in the peripheral Europe situation over the last 1 year or so has been a big driver of outflows out of emerging markets on and off. And we think this situation could resume again in the second half of this year, bringing further outflows, compounding the effects of the US interest rate rises.